this company is at the inflection point, ready to scale. You were doing, 40 million in annualized revenues. Your goal is to get to, 250 to 400 million in the next, within the next 12 months, 250 to 400 million annualized revenues. And to do that, again, you've said, okay, we're gonna sign, 4 or 5 of these deals where we're putting these drugs into our distribution pipeline, and that's obviously gonna drive the revenues. So this is the first one. Is it so Bernzavi? This is the first one.
It's our first pull through, full end-to-end first throughput with all of the compliance, the legal, the technology, the relationship, the cost point, the non-PBM, all of it. There's like 15 points that have to all marry beautifully together and harmonize, and we've been able to pull it all the way through. So why this is so important, and I don't think the market quite understands it yet, but they will, is that it sets us up for proving it out to other manufacturers because they're all on the sidelines watching.
All right, welcome everybody to Wall Street Reporter's next Super Stock live stream, where we bring you those stocks which have that 10x to 100x upside potential, companies going after massive multi-billion-dollar market opportunities that are at a key inflection point with multiple catalysts in place. And we're back with Wellgistics. Brian Norton, the CEO. Brian, welcome back to the program.
Hey, good to be here. How are you, Jack?
Fantastic. So we got some news today, news about you're launching a new product into your pharma distribution pipeline, which is Bernzavi. Now, this is a big deal. I think a lot of people don't realize how big of a deal this is, but I think this is, I believe this could be the inflection point. You tell me if I'm correct, but again, the idea, with what Wellgistics is doing, you're basically changing the game in this $600 billion pharma distribution business, helping patients, the patients reduce costs. Tell us about Bernzavi, why this is a big deal. What is this drug? What is the market? Why is this such a big deal for Wellgistics potentially?
Yeah. So, we've been working on this project, this initiative for about 3 months now, maybe more, probably closer to 4 months. There's been a lot of legal and compliance behind it for a couple of different reasons. And remember, maker to taker, direct to patient. And so when you go to a manufacturer and you carve out a particular drug, it has to meet so many different requirements to make its way from the beginning to the end. And so one thing that we created a little bit differently is for the ability to remunerate a pharmacy for performing services to help the patient in their community get into a better cost program, for a drug. I think I shared this last time, maybe I didn't, but Bernzavi is a low-cost drug option compared to its competitors in the high-ticket, high-cost brand of the same exact medication. So Bernzavi is for type.
Oh, okay. This is for type. What this is?
Yeah.
Go ahead.
I'll explain it. Yeah. It's for type 2 diabetes. Essentially what it is it's kind of, think of it like a sophisticated diuretic, in that it helps you properly, as a type 2 diabetic, it helps you properly urinate out the extra sugar in your blood, basically, is what it does. In a rough, I mean, I'm not a clinical guy and I'm not a scientist or any of that, but it basically helps the type 2 diabetic with the sugar in their blood by urinating it out. And usually it goes hand in hand with other diabetes medications like your metformins and potentially your GLP-1, like an Ozempic. And so it's kind of a combo maintenance drug called an SGLT2 that is specifically for diabetics, type 2 diabetics. All right. So think of it as it's a big market. It's about a $20 billion marketplace, right?
Yeah, a huge market. I was, just before we started, I was doing a little research. I mean, massive market. Like, and they're saying it's somewhere between $16 to $25 billion annually in the U.S. and it's growing. And what's interesting is this: what's interesting when I was Googling Bernzavi is, it comes up that was it Mark Cuban? Everybody knows Mark Cuban, the billionaire, the guy from, was it Shark Tank? He owned, what is it, the
Yeah.
basketball team, whatever it is.
Yeah,
And this guy's a
Mavericks.
smart guy. Listen, people can disagree with him on many things, but the guy's a smart business guy. And he knows a trend. So he started this very simple, kind of a similar business. I mean, similar in the similar space. What you're doing is like to reduce costs. I think he's got a different business model, but his thing is he's promoting Bernzavi, basically. That's one of his big drugs that he's doing. So, which I think is very interesting that, that this kind of validates, I think, the whole Wellgistics thing. Hey, if the smart money is going into the space also, something is happening.
Yeah. Yeah. So really, Mark Cuban there's nothing overly special. He's a distributor. And what he does, he says cost plus, where he's negotiating and getting the best possible cost from the manufacturer. And then he's putting a standard markup on it, like a 15% markup on it. Okay. That's what we do. Everybody does in wholesale. That's what everybody does. They negotiate best pricing. They mark it up 15%. Off it goes. Right. So, I think he leverages his name and his reputation and his strength to be able to get better pricing sometimes than others can get. And he's another alternative distribution player in the game. But he's not direct to patient like what we're building, right? And so remember, we get more stakeholders involved. We can move the drug deeper down the chain, okay? And think of it as, they call it first mile, last mile. Okay, your first mile is manufacturer, wholesaler, pharmacy. Last mile is pharmacy, physician, patient, doorstep, right? So the last mile, it gets more cumbersome because there's services involved. There's non-tangibles. It's not just, here's my drug, I'm shipping it to you. It's, how does the drug cover? Can the patient afford it? Does the drug have, is it something that has to go through the insurance, through the employer group? Is there a copay? Is there a deductible? Is there co-insurance? Does it have a prior authorization? All of that is the last mile that services the patient. Okay. And there's a lot of companies that do that independently with just one thing or just another. We've brought it all under one roof, and we service the patient and we move the drug together. So in that, what we did with Bernzavi is we said, hey, why not find all of the platforms that service employer groups on a large scale? Because the competitor of Bernzavi is between about $500 and $700. Okay, that's the cost point for that drug. Ours is between 50 and 100. Okay, so do the math. So if you're
this is per month, by the way, right?
Per month, yeah. If you're a large employer group and you have 500 diabetics, type 2 diabetics, do the math on 500 times $600 versus 500 times $65, right? So
that's a lot of money.
The savings for an employer group is tremendous. And then we take care of all of the onboarding, all of the work with the patient, all of that. And so the attraction to our program is very high because of those added value services, because of our technology, because of our speed. It just enhances the movement of a drug to the patient in a better cost, faster way. So because we get involved in everything, we become very attractive to groups like Theracos Bio, who owns Bernzavi, and that they want us to commercialize their drug. Okay, so take large grocery chain pharmacies, take other network pharmacies in different areas, take large employer groups, bring all of them together, and to have 10, 15, 20,000 patients a month on Bernzavi every single month, I believe is a very doable number. It's not going to happen overnight because we have to do the work to onboard them all. But I believe that the market more than renders it. As we said, the SGLT2 space is, average out, call it $20 billion space. One of the major drug competitors is through Johnson and Johnson, and they do about annually I think the last I saw it was like 3.2 billion with their SGLT2. 3.2 billion, right, through J&J. our drug Bernzavi directly competes with that drug. So for us to do, you know, a 1/5 of that number, I think we can go and compete because we're taking a Johnson and Johnson 3.2 billion annual drug that has a average $600 ish price point, and we're bringing a competitor to it that has an average of less than 100. Can we go capture
So,
some of that marketplace? Is my point.
so
And so that's where we're just like we talked about in the past. Just one drug has the ability to do 100 plus million in revenue annually. No problem.
okay, and I think this is what the market really has been waiting for. Is I think the story, the investment thesis, I think from when we started was, okay, this company is at the inflection point, ready to scale. You were doing 40 million in annualized revenues. Your goal is to get to 250 to 400 million in the next within the next 12 months, 250 to 400 million annualized revenues. And to do that, again, you've said, okay, we're gonna sign 4 or 5 of these deals where we're putting these drugs into our distribution pipeline, and that's obviously going to drive the revenues. So this is the first one. Is it so Bernzavi? This is the first one
It's
of
our
this.
first pull through, full end to end, first throughput with all of the compliance, the legal, the technology, the just the relationship, the cost point, the non PBM, all of it. There's like 15 points that have to all marry beautifully together and harmonize, and we've been able to pull it all the way through. So why this is so important, and I don't think the market quite understands it yet, but they will, is that it sets us up for proving it out to other manufacturers because they're all on the sidelines watching. Okay. None of the big manufacturers wanted to be first. And so doing this, improving this with Theracos Bio and showing that it's a big ticket market, right? This isn't some really specific, lupus where you only have like a couple thousand people, this is a big marketplace, right? And so, and it's diabetes. We have a metformin product we're working to bring on as well to couple that, so we can now have the SGLT2, the metformin, and then I'm really working diligently to have a GLP-1, which is like your Ozempic, all of them come together. So now, because we bring in thousands of patients on one type of their diabetes regimen, we can say, hey, Jack, you're one of my clients. You're taking our Bernzavi. We also have a metformin for you. Would you like to buy? Would you like to see that in a package deal and delivered to your doorstep? Oh yeah, I'll do that. Cool. We also have a GLP-1 Ozempic for you, or a Zepbound. We can get you. Oh, cool. So now, the momentum that comes from building a sticky customer that needs you every month and bringing more products to them, especially in the diabetic space, because diabetes, is usually 3 or 4 medications per month on maintenance. We want to be able to capture the patient and get all their products, right? So now we're adding
Okay.
more and more, and just you start doing the math on if we add, just pick a number, 10,000 patients per month. Now, not just Bernzavi, but metformin, Ozempic, other drugs that we can do with them that all kind of weight management. We can charge for services for managed care services. We can do a lot of different things that all kind of focus in on that one therapy base. So what would happen if suddenly we're at 20, 30, 50,000 patients a month? Now you can
Okay. And how
start to
much
see that momentum.
and how much revenue per patient could this be? Like, if you have, let's say, this whole package in the diabetes space.
It's a good question. If you just took Bernzavi and you just took a very kind of standard base number of dollar revenue, I think we can see many millions a month in revenue just from one product, right? And so for us, I think we're going to see, a substantial growth uptick in this one product. And then if I bring on a few others, I think we would probably get to a point where we could see as much as $200 per patient type numbers per month. And then
That,
in the tens of,
that's 20 million.
in the tens of,
Oh, sorry. So if you have 10,000 people at 200, is that 20? Wait. So how many? What's the math? I don't have a calculator here, but is it? Are we at 20? What's the number? Is it 20 million a month? No, 10,000 at 2. It's 2 million.
2 million. Mm-hmm.
10,000.
But remember that your multiples are always higher on RMR, right? So this is reoccurring. This is maintenance. Anytime you come out and you say, I have a book of business with 10,000 clients that buy a $200 product from me every single month, your multiple, I've seen multiples in the SaaS business in pharma at 38 times revenue. I've seen, incredible multiples in your ARR, right? Your annual reoccurring revenue starts to become really sticky when you have patients that need your services and need your products to essentially survive, to live. And this is their health. This isn't like, I'm gonna discontinue that. I'm gonna cancel that app, that game I have on my phone, or whatever that charges me every month or whatever, right? This is a life-saving medicine.
Yeah, exactly. Yeah, exactly. So basically, if you have 50,000 at 200 a month, that's 10 million a month. It's 120 million a year revenues from that one.
Just with one product, right? Now that's a great way to look at it. And growing that type of number in the market that we're in. Again, you have to look at all the other factors. Why would it be a fast onboarding process? Well, because all the major stakeholders save money or make money that we service. So yeah, it's going to be disruptive, and we're going to do a lot of marketing behind it because, again, it's like this, Jack. If you could go and buy a car and the exact same car is on one side of the street versus another side of the street, and over here that car is 100 grand and over here it's 50, same miles, same color, same year, same make, everything's the same. Why would you go to the $50,000 more car dealership versus the one over here? Maybe you're going to ask, well, there might be something wrong with it, but you do your homework, you look at it, you're like, no, this is in the pharma space. There are lots of competitors, and in a weird way, they all kind of stay in the same price thresholds. Well, this little company that acquired this asset called Bernzavi said, I'm not doing it like them. I'm going to compete against them in a totally radically different way. So they didn't go the traditional commercializing route where you pay to play, where you pay the PBM to be able to get the drug on formulary, and then you send it out to your McKessons and your Cardinals, and you hope for the best, right? And you let them take it out and go do their thing. You hope you can squeeze out a little bit of a profit margin, and then you still have the burden as a manufacturer to try and tell the world about it. McKesson just delivers it to the pharmacy. Nobody knows what the drug is until you commercialize it to the marketplace. So huge burden on these boutique guys that own these little brands competing against the huge big boxes. They don't have the ability to compete with billion-dollar marketing budgets. So they come to us and they say, hey, can you commercialize for us? Can you take it to market? Can you deliver us patients? Can you end-to-end it all the way through? That's the specialty, the differentiator with Wellgistics Health. Okay, this is what your investors need to understand, is that we are the rails of moving the drug for commercializing it all the way through. And many, many manufacturers are hungry for groups that can provide that service. They need that. They're looking for it, desperately looking for it, because the boutiques can't compete with the big boxes. And the boutiques are, in the 5 to 10,000 boutique manufacturers that have 2, 3, 5 drugs. Okay.
Mhm.
Then you got your big boxes, it's very 80-20, but you got your, your Lilly's and your Novo Nordises and your, Merck's and your Pfizer's and your Johnson and Johnson's. They all have, you know, huge, $100 billion a year type companies that have huge budgets that can just pounce on these little guys and how they can go to market and then what they can pay and what they can do. And so the little guys are in a lot of ways kind of the focus for us, like Bernzavi, like Theracos. But
Okay.
at the same time, the little guy has to be able to bring a drug that can compete in therapy with the big guy. So as soon as we find that, we say, all right, little guy, we're your man, we're your guy, we're your group. We're going to take your drug, we're going to compete against the big guys, and we're going to totally go to market in a different way. But we got to kick out all the crap that consumes the cost of the drug, throw it all out, and then we're just going to get granular. How much does it cost you to make it? How much are you willing to make selling it to us? You get your profit, check. You're good. You're making your whatever. 50, 80, 120, $200, whatever your margin is, we'll take
Mhm.
that. Now we have to take it and we have to bring it to the marketplace ourselves to commercialize it through employer groups, through large third-party administration groups, through our pharmacy network, through our grocery chains, through all these different groups. And that's when we start to get momentum, right? Now we start to see all these companies saying, hey, we can save from a $600-700 price point that we, the employer group, are paying. We can save $500 per patient per month. Okay. And that's a real number on Bernzavi. It's $500 per patient per month savings to the employer group.
So let's say, what is this actually called? The Bernzavi? Is that would that be considered a generic, or what is that called? Like in
The
this,
brand.
is that we're not on a generic? What is it?
It's a brand.
It's an old.
It's a brand drug.
It's a brand.
Yeah.
It's sort of like there's like the first one was, I don't know, whatever. There's all these names. Everybody comes up with these crazy names, but like
Januvia, there's Jardiance, Januvia, and Farxiga.
Okay.
Those are your three.
So okay, so whoever was the leader in the space, whatever it is, but these are all basically, they all do the same thing pretty much, right? They all do the same.
Yeah, they're all SGLT2s. Yeah, they're the same thing essentially. Their strengths might be a little bit different, but the doctor will write according to the strength, right?
Okay. So how many? Okay, so this is the thing that's very important, right? Like, you're going after these pharma, to these manufacturers, right? You're saying, okay, we're going to be, we're going to distribute your product for you. We're going to do a great bang up job. So the first case study you're really presenting is Bernzavi right now. Because what you're doing with this whole, like, this infrastructure thing, this rails, this infrastructure, which is the main way you cut costs. This is what they need to see, right? So once they see that, once other manufacturers see that, they're also going to jump on board. Is that fair to say?
Yeah. Think of it like, and what we're doing very diligently right now is everything is very meticulously white papered and recorded and presented in such a way, or put together in a presentation in such a way that when we go to the manufacturers, the other side of it is they want to see historical. They want to know that, all right, you have it all. We can see it all. It's beautiful. I can walk through the tech. I can enroll. I can put all my, pre-existing conditions and show that I can qualify for it as a patient, and like the whole thing that you do with us. And then, cool, that's amazing. But how many patients have you brought through the system? How long have you been doing it? That's the next piece that we want to get through in Q4, is being able to show, thousands of patients through our program seamlessly, flawlessly, saving everybody money, doing exactly what we're promising to do. Then we take that to 10 other manufacturers, okay, who are very much on the sidelines watching. And we say, hey, look what we're doing. Right.
Okay. So bottom line is right now, this is you're building a case study right now with Bernzavi over the next few months. And you have 10 more prospects, which could be, again, drugs, which I'm assuming are just as big as Bernzavi, which could be next. And once you get those, that's your path to that, 250 to 400 million in 12 months. run rate.
Yep. Yeah. And look, we are in a space right now where every single player in healthcare in one way or another could turn to us and use our services or our products. Okay. So it's never going to be just one isolated thing, because if a group called me up today and said, "Hey, we want to use your pharmacy," and we're starting to see more of this as well, where we send you the prescription, your pharmacy intakes it, does all the pharmacy work, and then ships it out to our patients, and we want to act in behalf of that large group. We can take that and do that, and just it's pure profit, it's pure cash, it's pure money, right? We can do that all day long. In fact, we'll have a very big increase in Q4 just on our pharmacy alone. So we have our own internal pharmacy. We can ship in all 50 states but California right now, just because we're pending California licensure. But a lot of groups need a 50 state licensed pharmacy to help fulfill for their patients, and they'll pay us to do that. Okay, so our fixed overhead at our pharmacy, nil. It's not much, it's not a whole lot. We've got you can get a lot done with it, just a small handful of people. It's in the door, out the door. It's processing prescriptions through, and it's flat rate fees. It's 25, 30, $35 flat rate fees that no matter what happens, we make that money by servicing that patient all the way through. So that revenue stream is growing exponentially right now, week over week, month over month.
Brian, I think your internet froze. Just when we're getting to the good part. Brian, yeah, your internet. Okay, your internet froze just as you were getting to the good part. You were saying revenues are going exponentially.
Yeah. So I'm saying, like, we don't just say, oh, our only revenue model is Bernzavi, right? We have so many different revenue models. We have all these different manufacturers that want to just sell us our drug, and then we still have 6,500 pharmacies in all 50 states that want to buy our products. And we generally run about an 18, 19, 20% gross profit margin just doing that. So if I buy a drug, I sell a drug, I can make 20% margins. Okay, I buy $10 million worth of drugs and sell $10 million worth, $12 million worth of drugs. I have a gross profit of $2 million per month. Okay, it's that simple. It's buy, sell, buy, sell. Getting into all the other things, our SaaS model, our membership fees, our hub services, those are all ancillary revenue streams. Okay, and we provide for the market for anybody that comes to us. Boutique PBMs that call themselves transparent PBMs, they're looking for alternative, whether it's services or better pricing on drugs to get to their patients. They may service, a state or two with a couple big, large employer groups, and their job is to help get pricing down and better services to those groups, right? 500,000 lives, 1 million lives. Okay. They would come to us, and we would deploy all of our features, services, tools, AI programs to assist them with their 1 million patients. Okay. All of these have revenue streams. And so the way I like to look at it is we've built a platform that is PBM agnostic. We're not necessarily only specific to one revenue stream and nothing else. We have the ability within what we do to not get diverted and out of focus, but to be able to fulfill for just about every aspect of the drug world. Okay, anything in the drug world, from somebody who makes it to somebody it's already here and it needs the final mile, to a pharmacy that's struggling, to an employer group that needs a better price point, to a direct patient model of 10,000, 20,000, 50,000 patients that all need a better platform for a drug, right? All of it is within our bandwidth to service and to help.
Okay.
And so there's all these revenue streams, and it's hard sometimes to pinpoint a forecast even sometimes, because we have, from one month to the next, we might have a group come to us that suddenly wants to do 50 million a year in revenue with us that I have to, take in and figure out and make sure we can service. But that that changes really rapidly. And that's because the market is so big and it has so much demand that, it's not uncommon to see some new pop up, out of nowhere that says, hey, we want you to do this for us. And we'll get, we do the math, we look at it all and we say, wow, that's $100 million a year opportunity. So it's not, it's not fixed. It's variable, and it's not a space that has.
This
Go ahead.
what you're referring to now is on the let's call it taker end of it, right? Like in other words, you're talking about the on the distribution side. In other words, the main I think the main so what's the main challenge right now? The main challenge that you have is getting the manufacturer, getting the deal with the manufacturer. That's the main challenge because you already have all the various channels figured out. Is that correct?
Yeah, that's great. That's a great assessment. So the biggest challenge is, so checking all the boxes to get to the manufacturer was our first challenge, right? So technology box, compliance box, right? A lot of compliance. We're in the most regulated space in the world, right? So a ton of compliance. So first one is physicality of a distribution center. Okay, not an easy task in and of itself. It's about a 2-year thing to get done for anybody. Licensure, warehousing, set up all the tech inside of it, serialization, all of it, right? FDA, DSCSA, Board of Pharmacy, tons. Okay, step one. Step two, technology that helps the prescription and the patient flow. Okay, got that. Check. Step three, all the compliance and regulatory, lawyers, right? Lots and lots of lawyers. Check. So check, check, check. Final stage, manufacturer. This is all done. We have it ready for you. We want your drug, and we're going to take it all the way through. Okay. That's when we go to the manufacturers now. And so we got all those check boxes, and then we went to this manufacturer and said, we want your drug. Here's what we're going to do. Here's how we're going to do it. And they loved it. They absolutely loved it. And so they were our first big launch because they fit all the proper pieces. We want to save the patient money. We want to save the employer group money. We want to make the pharmacy money. We want to make the manufacturer money. And we want to make money. So that's a tall order. I mean, if you really look at that, that's a tall order. But we did it, and we're now doing it, and we're going to start executing every day on that. And so, putting it all together, getting it all completed, making sure that it's ready, and then doing it. Okay, now, because everything's built, the infrastructure's done, no more CapEx. You literally go to the manufacturer, new ones, just start picking them off. Okay. And we have a whole team that's kind of designated to finding the next Bernzavi type drug, that finding the next one that the manufacturer's willing to go an alternative route, is not playing the rebate game. So there's that whole piece that takes time and it takes development.
So you have a whole team. You have a whole team of people researching this different drugs, potential drugs to put into your pipeline. I'm curious. So you mentioned 10. You mentioned you have I think you mentioned 5, 6. How many realistically? Let's say a year from now. Let's say this is working, right? Let's say the Bernzavi case works out, right? How many? If it works as well as you think it will, right? How many new drugs potentially could you put into your pipeline, into your alternative distribution pipeline, based on what your guys are looking at?
Based on capacity? Is that what you're saying?
No. Based on
what we could reasonably do next year.
No, prospects. In other words, you have a team that's looking for new drugs. How many? In other words, you have a pipeline of prospects, right? So they're looking at, I don't know, are they talking to 100 guys? Are they talking to 50 guys? And what percentage of them do you think you can close? And what's what's percentage? That's what I'm asking.
Yeah.
Does it make sense?
We have a really impressive outside consulting group of about 5 guys that are really, really big, really good at what they do. They've been in the space for 20 years and they know everybody. So we have that. And then internally, we have 3, including myself, 4 people that are all in business development, right? They're all either BD or sales to pitch our program to manufacturers, to employer groups, to pharmacies, getting them all linked in. And so we got a very robust. I don't look at it like I think of it this way. The Bernzavi project, end to end, golden all the way through. Let's call that like gold. I wouldn't say gold. Let's call that platinum. Okay.
Mm-hmm.
And then we have, other models within our business that are like gold, silver, bronze. Okay. In that it's not necessarily based upon, the biggest dollar amount, but it's based upon volume, or it's based upon predictability, or it's based upon reoccurring revenue, right? So you get all of them together and you have these Bernzavi. Let's say I can only do 10 Bernzavis over the next 12 months. That's still really, really exciting to me, right? Because it is a challenge to get all of the checkbox from a manufacturer to want to do the Bernzavi type deal, right? Because remember, their alternative is to go through the PBMs and Cardinal and McKesson and just kind of dump their drug into the market and hope for the best. And they might be succeeding, or they might think they're succeeding doing that, versus us having to show them a different route. And then there's risk, right? So to get 10 Bernzavis, I think it's very doable. To have tens of thousands of patients per month on each one, I think is very doable. What challenges might come our way that I can't predict, I can't speak to, but I can tell you that the desire for what we do and the demand for what we do is increasing exponentially at the manufacturer level. The drug makers want a different route of delivery. And so we offer that. We're one of very few that are offering that to the drug makers. So getting that platinum, get 10 plus of those by end of year next year, I think that's very much possible. Having many other revenue streams also in place, just distribution with new deals with manufacturers, just saying, hey, look, we'll open you, we'll sell our drug to you, you go sell it to them. Done. Like, we don't want to do all your special end-to-end stuff. We just want to sell you our drug and you go sell it to your pharmacies. And we look at that and we go, wow, we have big demand from our independent pharmacies to buy it. We can move 500 of this drug. We can move 1,000 of that one. We can move, whatever of that. And just distribution alone is, again, you've seen, I've talked to you about this. I've done this in the past. I just did distribution buy, sell in the past, and I've done 200 plus million a year. So to just get that in distribution and not have all the specialty side, the end to end, I think that in and of itself is 250 million next year. I think we can do that. I really do.
Okay.
That's kind of, the Bernzavi will have distribution built into it, but think of that as kind of a separate revenue stream from the full specialized end to end. Okay, so that's important because I can always just buy and sell drugs. I can distribute like a McKesson or a Cardinal. We can do that all day long. It's just growing that, building that, churning the profits to keep growing it. And like I said before, if I put 10 million into buying a drug and I have a 20% margin, I can turn 10 to 12. I can make I can make a $2 million a month gross profit just in distribution alone. But why we did what we did with Bernzavi, why we keep talking about direct to patient, is because that's the differentiator. Somebody can come and take my distribution and compete with me, and the guy, if I'm taking a 20% GP and the next guy down the street wants to take a 19%, now I'm at war with that guy. And then I go, you know what? Fine. I don't want to lose that business, so I'm going to drop mine to 18. And then he says, well, I don't want to lose it. I'm dropping to 17, 15, 14. That's what happens in our space. And it's really, really difficult to not have a race to the bottom. So
you have multiple,
we try and protect that.
Okay. So basically, you have multiple channels for the distribution. Either you can sell directly to pharmacies, or you can sell directly you go to patients, whichever way. So you have, okay. So I think this kind of answers what Javier was asking earlier. Was, I guess he's asking how many how many new drugs. So basically, you said 10, potentially 10 of these new products?
The platinum, the Bernzavis, right? We have 700. It's a little less right now. We probably have 500 SKUs in our warehouse. I don't know. Did Tony do a little film of our
Yeah,
warehouse and
show us
stuff?
the warehouse. Yeah.
Yeah. So
Okay, so
at
you're
any
talking,
given
okay, so
point,
you
we
talking about
have 500
when you
different
say
drugs
the
that are just
10,
out the door.
okay, you're talking about 10. These are like big, these are like, $100 million
Blockbusters.
potential drugs, basically. Okay.
Yeah.
The other stuff is
Yeah.
smaller. Okay, got it. Makes sense.
Yep.
Okay.
The others, just remember that we have 200 plus direct manufacturer contracts to buy their drugs. I can go to just about any drug maker and I can buy their drug, and then I warehouse it, and then I have to go and get my sales team to sell it to a pharmacy, and I'm pushing for a 18, 19, 20% gross profit margin. Done. And that's a world that I know very well. That's what I did. That's what I've done for 10 plus years. I know that space. But the market is not asking for another wholesaler. We can do it, we'll do it. The market is asking for somebody who can go beyond wholesale, who can service, who can work with the patient, who can manage the care, who can do it all. And that's what Wellgistics Health became. Wellgistics LLC was my company being a distributor like a McKesson. Wellgistics Health is a full distributor, pharmacy, hub, and tech service built into one. Okay, it's all rolled up into one ball, and we control the patient. We control every aspect of what happens in that platform. So now, instead of buying it from a manufacturer, warehousing it, and selling it to a pharmacy, and then I'm done, stop, wall, it goes buy it from a manufacturer, warehouse it, sell it to a pharmacy, or sell it to our own pharmacy, and continue to service the patient all the way till they receive it at their doorstep, right? Whether it's through the local independent or through our own pharmacy, now we're getting into all the nitty gritty of coverage and affordability and employer group coverage and our own copay platforms and all the things that enhance that patients want to and employer groups want to work with us. Does that make sense? I hope I'm
I think
making
it does.
sense of all that.
Brian, I think what's going to make sense to 99% of people is when they see the numbers, basically.
Sure.
Like they're not going to care. Like, in other words, ask people about Palantir. Does anybody understand Palantir? I mean, the CEO of Palantir can talk for 5 hours. Nobody's going to understand all. It's just not going to understand. They're going to understand part of it. Like somebody in your business will understand it. Yeah, maybe a doctor will understand it, whatever, or somebody who's in the space. But the bottom line is you're doing alternative distribution in the pharma space. You're creating value. I would say the best example for the retail investors. Okay, you got Mark Cuban doing his cost plus, so you have that type of business plus wholesale as well. To make it to simplify it, and you're doing something better.
We can do anything cost plus can do with Mark Cuban's business, no problem. We can do anything a McKesson or a Cardinal can do. We can do anything a Hims or Hers or a Row.co can do, right? We can do all of it. We can do what Alto Pharmacy does. We can do what Gift Health does. We can do what a lot of groups do. We can do everything, okay? And because we can do everything, our revenue potential is very, very high. Yes. Sorry, go ahead.
Yeah, so speaking of these like direct consumer, like these Hims or Row, whatever it is, like to do that business, that becomes more of like a consumer marketing business. Do you have like the infrastructure to do that? Because that's a slightly different business model, isn't it? A slightly different model?
Yeah. So we would likely not do anything where we're B2C like a Hims, right? We wouldn't directly go after the lifestyle medication market. But what we would do is we would think of it a little bit more like wholesale for groups that are doing the B2C but need us to perform the movement and the work.
Okay.
So think of us like a third party affiliate that they need to go through to get it done. So for example, Novo Nordisk launched their direct-to-patient Ozempic, but they use third-party pharmacies and direct-to-patient groups to get that done. They don't do it themselves. They farm it out and they pay a fee to do it. They call it theirs. They own the kind of the rights to say it's their direct-to-patient model, but then they they third party out groups to do it for them. So we would, if we did anything like a Hims or Hers, it would be because we're fulfilling it for large institutions or groups that need us to fulfill their patients and pay us to do it.
Okay.
And I like those.
Got
I
it.
like those models because we don't have to put all the marketing budget out. We don't have this huge cost of acquisition or this, ROAS and all the other things we're focused on. We can just take in a group that says, "Hey, I have 50,000 people who all need this one testosterone cream," and you ship it to all 50 states. We'll send the patient to you. You do it all through your pharmacy, charge the cash, do the whole work. We'll bring you the patient, but you do all the work. We like those models, and those are
Okay.
very much on the table, and we get a lot of requests for that kind of stuff.
Okay. Interesting. Okay. So that's so there's multiple multiple ways or multiple channels. No. Okay. Bottom line is, I think, look, the takeaway for today is the company's at the inflection point with this Bernzavi. And the idea is there's going to be more of these Bernzavi type deals, and we're going to be seeing it. I think what people are going to be looking for is, okay, when do we see if this is working? Like, how long is it going to take before they see numbers, or when can you report some sort of metrics where they can see, okay, are these guys on track? Like, when would that happen?
It'll be very clear end of Q4, right? So give us Q4 to be able to really show it. I'm happy to get on and talk at the end of each month, kind of as to basics of kind of how we're doing and what we're doing. But I think we're going to have a good Q4. I'm very, very excited about what's happening and what Q4 is going to look like. So, that should answer your question. Clearly, again, those who are long with Wellgistics Health and who want to see what 26 looks like, it's going to be a very exciting ride. I think we have all of the major pieces done and built, and we are generating revenue. I mean, we're not a non-revenue company. I want to be at break even as fast as humanly possible. As you know, your team probably saw that we just raised some money. We just raised $5 million. That's good. I want more. I always want more because I can deploy it and I can buy product. I don't need to put money into a new warehouse. I don't need to put money into new technology. I don't need to buy a new C-suite. I just need to buy product. And so deploying cash is really easy for me in that I can grow as fast as I can deploy the capital. I don't have like a demand problem. I don't have a supply problem. I just have to make sure I have enough capital to carry the deals that we strike. If all of a sudden Bernzavi, I have a couple large groups come at me and say, "Hey, we have a total of all of us together, 25,000 patients." I have to make sure that I can financially carry 25,000 patients with purchasing the product, doing all the work, making sure the team's all up and run. There's some cost structure behind mainly just the acquisition of the product. And so that's really just what it boils down to. And so if I were to say any of our challenges or hurdles or threats, it's really mainly the fact that the more money I can get in, the faster and more I can deploy, and the faster we show results and profit. So it's churning that as fast as I can churn it. But I can only churn it. Think about it, like I can only churn it every 30 days because that's the life cycle of a patient. It's every 30 days. So I can't force it to churn faster than 30 days, but every time I do churn it every 30, I want to roll those profits back in and buy more as much as I can.
So the capital, so just to be clear, right? Because investors are always concerned about dilution and this and that, it's always valid, but this actually, okay, so this 5 million you raised, this is actually growth capital. This is going directly into
100%.
Funding inventory, the whole basically revenue cycle now. Once that goes, I mean, the valuation goes up. So there's actually you're raising at a higher price, et cetera, et cetera. So is it possible to say like the current raise, like what kind of revenues would that support? Let's say the 5 million raised, is that enough to support, 25 million, 50 million? Like is that does that
Well,
question make
again,
sense?
the capital's accretive to the bottom line, right? So we're fixed with our overhead. We don't have to put more capital expenditures together for some new M&A or some new tech suite. It's all done and built. So when you start asking the question of what are you putting your money into, well, a lot of that is yeah, you've got your fixed overhead, right? You've got your payroll, right? That's monthly. You've got your burn, which is just your monthly burn to keep the business up and running. So the fastest multiplier of growth is to deploy your capital into purchasing a product that has 20, 30+% gross profit margins. Take those profits, roll them again, roll them again. I mean, but again, you can only roll them so fast. So
Right,
as
right.
long as we can keep rolling, take five and roll it three, four times, okay, great. We can show that growth. I think my frustration sometimes fall into I want more because I can deploy more, right? If I had 50
Hmm.
million right now, I could deploy 50 million into product with 20+% profit margins. I could do it. I can't turn that spigot on to go get the demand because I don't have the
Hmm.
ability to support the demand with the supply for the capital cost. So that's my frustration sometimes, my constraints. Once we're a year old company, come February, March time, which is feels like it's coming right around the corner,
Yeah,
things
5
shift a
months
little bit,
away.
right? Now we can do a S3, we can get into ATMs, maybe we
Yeah.
can look into other vehicles that as we're growing, showing the growth, we can pull more money from that growth market with liquidity in the company we can pull. And that's an exciting prospect that we can raise capital at a faster rate because of our growth being at a faster rate, which is only
Okay.
common sense to any investor on this call that we can only grow as fast as our capital will allow us to grow.
Okay. But right now, I mean, the stock is on. I mean, you're on a trajectory to do this. Couple hundred million a year annualized revenues with what you have right now, or will you need to raise more money to get to this number? Let's say
Um,
250.
yeah, that's a good question. It depends on how we look by the end of the year and where our break even point really hits. Because once we hit break even, it should start to continue to compound.
Okay.
We may not need to take more money, but we'll see. Um, Again, I'm a little more bullish on raising more capital because I can deploy that capital into growth equity and prove out that we have the demand. We just need more capital. So whether that's equity and dilution or whether that's debt structure, we may be able to structure something on a favorable debt structure. But eventually I need to get to a point where I'm out looking for 50 to $100 million so I can go to 3 to 4 billion,
Right.
and
I mean,
we're
I think this
structured
is what.
to do that. We're structured to see that take place. Okay. There's nothing else that needs to be built to do it. We're structured to say, if I had $100 million, I can turn it into 1 billion in revenue. Okay. Or more because of the fact that it's all growth capital right now.
Okay, so basically the infrastructure is done.
Yep.
And so at some point, so in other words, and that's the path. I mean, it was because you did mention your goal is not to be at 250 million revenues, but really to be this multi-billion dollar company,
Correct.
multi-billion dollar
Yeah.
annual revenues. I think you said up to 4 billion. I think you said 2, 3, 4, $4 billion, which by
Yeah.
the way is
Look,
still a
if
small
I'm
player
not,
in the space. Would be actually a
yeah,
relatively small player. It's not even a big,
yeah,
you
yeah. I mean, $1 billion a year just in distribution is not uncommon. Like just distribution, there are plenty of groups out there that do 1 billion in revenue, and they're 5, 7, 8% gross profit margins. But it's not hard to do 1 billion revenue because there's some drugs that have 3, 4, $5,000 price points, and you're doing thousands of those a month. I mean, you can do the math really quick of what you can do a year just with a handful of drugs. And so, pharma revenue is not overly complicated to get to a billion a year. It's when you're getting to RMR, okay, or ARR, that's a whole different game, right? When we get sticky customers on an annual reoccurring revenue at 10, 20, 30 million, 50 million a year, that's very exciting. Your multiples are very different under that platform.
Okay. Oh, so just to clarify for anybody, so basically, you're talking about, so the thing, what you're really after is the monthly, is I guess these drugs for chronic diseases which require monthly. It's a monthly recurring revenue versus one-off drugs out there. For
we can do both. We can do both, right? We can do non-sticky, non-reoccurring, but the reoccurring revenue,
the margins are in the. I mean, not the margins, the multiple, the valuation.
The revenue is high on distribution. The margins are low and the stickiness is not so strong, right? Because again, somebody could come in and say, I want to compete against Wellgistics on I'll take a lower margin and I'll compete against them with the pharmacy. The stickiness of having a direct to patient platform where the patient is who we control all the way through is now your ARR. That's where your multiples are enormous, right? And that's what everybody's looking for in the pharma world, is to really get greater sticky power with more customers that rely upon your entire infrastructure, your ecosystem. Okay. And that's what I want to build is if it takes more, if it costs more, if it delays us a little more, I'll be patient through it. But if I can, as I do this, as we build this, as it's being built and as we're executing, we're going to prove out to the marketplace that it can be done and that the ARR on it is really, really powerful. Okay. Which will create bigger valuation, bigger multiples.
Yeah. So basically, like the direction you're going, you would get roughly, let's call it a 5x multiple on revenues if you have this sticky recurring revenue, which is kind of like what
it would be bigger than that. It would be much higher than 5x on a ARR. Your ARR with your tech stack as a healthcare tech company is going to be, I think it'll be up in the 15, 20 times multiple.
Really?
Mm-hmm.
Because
you're at a potential 4 to 5 times multiple just in a standard, typical business model. Like, I think a McKesson or a Cardinal type distribution model could value at a 4 or 5 times multiple. I think
like a 1x. But
it depends on a handful of factors, but at the end of the day, I've seen SaaS software companies come out of the gates on year one with, if you're at $1 million to $2 million in ARR, their valuation is upwards of almost $100 million. I'm watching it happen on a different company right now. So the stickiness factor of your ARR. I mean, look at some of these other valuations on the AI companies that are launching right now. They're astronomical. They're in the billions, and they only have, another company, I can't remember the name of it, but they're doing 100 million in ARR, and they're in the multiple billions valuation now. So
I think, listen, I think even if you got a 5x multiple on let's call it 400 million in revenues, 250 even, that still would be, billion to $2 billion valuation divided by the share count. That's a 10x from here for investors. It would be, the stock would be $10, $15 a share. So I mean, just for starters, that's a good starting point. That's I'd be happy with that.
Yeah, look, $1 billion market cap, 250, 350 million next year. I don't see that being something we can't do. I just don't. I see all the things we've built. I see what we have. I see our market. I look at all the factors. I just don't see it being, something we can't accomplish. And so I'm very bullish about it. I'm very excited about it. I know we can do it. I have the team for it. I have the infrastructure. So it's just a matter of executing. but I am running really behind.
Okay.
So I do have to go.
Yeah. All right. Thank you again. Thank you, everybody, for joining us. We'll see you on the next live stream.
It's always a pleasure, Jack. You always have great questions. I love your inquisitive mind about our business.